Welcome to Module 2 Part 2's video on tax planning. So a lot of this is not in the book, so I've had to do a supplemental reading offering. We're going to break it down into three parts in the video. There are actually four in the reading, but that's because I just think you can combine jurisdictional and entity shifting into one. That's just income shifting. Anyway, SpongeBob wishes to lower his taxes, so he invests in tax-exempt bonds and thus lowers the average and effective tax rate. Remember, tax equals rate times base, and so the rate that he's going to apply to his tax-exempt bonds is zero. And that seems like that's a pretty good strategy. So Patrick wishes to lower his taxes. So as a result, he just quits his job and becomes a penniless hermit.
See what I mean, Patrick?
Where's the leak, ma'am?
He's also lowered his taxes. And so the lesson here is that effective tax planning requires consideration of both tax and non-tax factors.
The inner machinations of my mind are an enigma.
In general terms, effective tax planning maximizes the taxpayer's after-tax wealth while achieving the taxpayer's non-tax goals. And I'm going to pursue this in three basic planning strategies: timing, income shifting, and conversion. And income shifting you could use as either entity shifting or jurisdictional shifting, but I think going through one so readily explains the other, it doesn't require that much effort. Okay. So let's do a very basic example for taxes. So would you rather pay $100 tax today or pay that same $100 tax in 5 years from now? And I think most of us agree that we'd rather pay it in 5 years, right? We'd rather pay for our hamburger on Tuesday than today. And that's largely due to the time value of money, right? The present value of $100 today equals exactly $100. But the present value of $100 5 years from now is actually less than $100. And in fact, if you assume a 5% discount rate, it's only $78.35. Now, there's no expectation that you are a finance expert or even that you've been through BA 323, although it definitely is helpful. If you have not, I'll post a couple of Khan Academy videos out there on the basics of time value of money, and you can go watch those as well. They're short, sweet, get right to the point, unlike me sometimes. Okay, so here's the difference of things over the last 20 years. So the average value of a new house in 1999, $119,600. Today it's over $200,000. A new car. So you can see that what happens is over time, the purchasing power that a dollar has is reduced, and it's reduced largely through the inflation, cost of living increases. So obviously, if we're comparing dollars today with dollars tomorrow or dollars in the past, for example, larger positive cash flows are generally preferred, and smaller negative cash flows are generally preferred. Okay, so the underlying presumption of positive inflation generally means that a future outflow is preferred to a current outflow, and a current inflow is preferred to a future inflow. So since after-tax cash flows equals pre-tax cash flows minus taxes, we need to worry about taxes as part of after-tax cash flows. So I received my property tax bill on December 1st of the year X1, and I can pay and therefore deduct my taxes on December 31st of year X1, or I could wait and pay them on January 1st of year X2. The difference is if I go with choice one, I pay that $100 property tax bill this year, I'll deduct it for taxes this year. If I pay it one day later, I'll be able to deduct it only for taxes next year. So if we assume a stable 30% tax rate and a 5% discount rate, Choice 1 has a $100 pre-tax cash outflow, $30 of tax savings, and nets a $70 outflow. Choice 2 is a $100 outflow and $30 of tax savings, which results in an after-tax cash outflow of $70. So you ask yourself, what's the difference, right? $70 versus $70, who cares? But we have to consider present value for choice 2. So the formula for present value is present value equals 1 divided by 1 plus the rate of the discount rate to the number of periods, raised to the number of periods. So we would examine 1 divided by 1 plus 0.05. 0.055% was our discount rate for 1 year. And we see that the present value factor is 0.9523. So the present value of that tax savings of $30 is only $28.57. So as a result, the present value of choice 2 is an outflow of $71.43. Choice 1 is clearly better by $1.43. And since we'd rather have smaller cash outflows, we're going to go with choice 1. So there's a few very important assumptions we made. And again, if you're not super familiar with finance, go out and watch the Khan Academy videos that I'll post. So there's a few important assumptions. The one is the discount rate. So that's really based on our risk expectations, right? So discount rate is this idea of how much risk we're taking on by assuming we'll get that deduction in the future or get that payment in the future. Sorry. Equal tax rates is the other assumption we made. So what if tax rates go up next year to 35%? So now the present value of that tax savings is $35 times 0.9523 or 3333. And now it should say now choice 2 yields the net present value of after-tax cash flows of only 66, making that clearly the optimal choice. So with a higher tax rate, we generate higher tax savings. So how do we typically get the rate? Well, we almost always use the marginal rate. But of course, the more the income may vary, the more tax rate uncertainty we have. So sometimes if we're dealing with an income variance that's much more than $100, maybe it's $100,000, then we have to worry about bracket shifting on top of everything else. Okay, so when income is taxed or an expense is deducted, when income is taxed or an expense is deducted affects the associated real tax cost or savings for two reasons. The first is the time that income is taxed or an expense is deducted affects the present value of the taxes paid or the tax savings on that deduction. And we just went through an example of that, how the timing of that payment when it's taxed affected the present value of the taxation. Now, technically, there was also a difference in the pre-tax payment, but it was only a day, and so we can kind of wave our hands at a one-day present value difference. The second one is the tax costs of income and tax savings income vary as tax rates change. So when considering cash inflows, higher present values are preferred. When considering cash outflows, lower present values are preferred. Okay, so we've talked about that present value formula. There are also present value tables. So note that there are generally two tables, just in case you decide you're going to use tables. And to the extent we do present value calculations, tables will be provided in your table pack, although a decent financial calculator does that job as well. So present value tables provide the discount rate for a lump sum or a single payment received in N period using various rates of return. That can be differed from the present value of annuity tables, which provide the discount rate for a series of equal periodic payments received over N periods. So only make that distinction so you potentially don't get lost in the tables if you decide to go there.
That's crazy talk.
It's not crazy talk. This is crazy talk.
So at a recent holiday sale, SpongeBob purchased $1,000 worth of furniture, no money down, no payments for 1 year. So how much money is this deal really worth if we assume his after-tax rate of return on investments is 10%? So that's the same as his discount rate. So we would take the present value equals the future value divided by 1 plus r to the n. So that's 1,000 divided by 1 plus the 10% discount rate for 1 year, or 909. So he saves $91 by waiting to pay for 1 year, because the idea is he could take that $1,000 and instead of purchasing the furniture with the cash flow today, he makes that cash flow a year from now. As a result, he gets a 10% return over that year. Okay. So the tax perspective, recall this from the previous slides. You could pay the property tax this year or last year, and we know now that the difference is that $1.43 that affects the present value of the tax savings. So Chum Bucket Corporation can deduct $1,000 in 2017 or in 2018 by paying on the last day or the first day of the year. So it can either make the cash payment in 2017, make the cash payment in 2018. The big difference between 2017 and 18 is we had a giant tax rate reform. So in 2017, corporations paid at a top marginal rate of 35%. In 2018, it's flat 21%. So now we can see two components are affecting the outcome: the timing of the payment and the rate that applies to the payment. And so when we analyze this using present value, you can see that the choice 1 absolutely just crushes choice 2. And that's a function of the combination of both the tax rate and the timing effects. So the timing is better for payment in 2017 because we deducted immediately, and the deduction creates a much higher tax savings of $350 versus $210. So that yields two basic tax-related timing strategies. The one is accelerate deductions, because accelerating deductions generally presents a greater and quicker tax savings, and the timing works out. The second general policy to follow is to defer income, right? So deferring income generally results in paying the tax later, which is thought to be optimal. However, when tax rates are decreasing, taxpayers should accelerate tax deduction in earlier years and defer taxable income in later years. Well, of course, why? Accelerating deductions maximize the present value of tax savings from deductions into earlier years with that higher tax rate. That's what we just witnessed in our 2017 versus 2018. When tax rates are increasing, however, now you have to calculate the optimal tax strategy. So what that means is you actually have to do the math. You can't just apply the general rule, because the benefit of accelerating the deduction may outweigh the disadvantage of recognizing the deduction in a lower tax rate year. Same with the income. That may go the opposite direction. Okay, so having decided he needs new equipment for the Chum Bucket, Plankton is now considering whether to make the purchase and take a corresponding $10,000 deduction at year end or next year. He anticipates with the new machinery his business income will rise such that his marginal rate will go from 21% this year to 28% next year. Assuming an after-tax rate of return, or aka a discount rate of 8%, what should Plankton do? So the tax savings, if he pays it in December, is pretty straightforward. $10,000 times 20%, or $2,000. And there's no present value to apply because that's in current dollars. However, if he waits till next year, he'll save $2,800. But when you discount that back, it's only $2,500. Well, $2,593 is still greater than $2,000. And so you almost certainly opt for paying the savings in January, because the rate increase, the tax savings increase, more than offsets your inability to take that deduction till next year. Okay. So a tax deduction can offer, one of the limitations of timing of tax deductions is, of course, you generally cannot accelerate it without the actual cash outflow. So in most instances, you cannot take a deduction until you actually pay it. So to defer income, you generally are unable to, for example, sell a property or asset that you are holding. So if you wanted to sell it now and capture the economic gain, but perhaps defer the tax gain, that's generally very difficult to do. So deferral strategies may not be optimal. Whoa, hey now, all sorts of messages coming in. Has cash flow needs or continuing investment generates low returns. So if you're concerned, for example, that you own a stock and it's appreciated in value, and you're like, wow, I really wanted to defer the gain till next year. Well, the gain may disappear because the stock price may go down, right? So you're accepting a certain amount of risk often through some of these deferral strategies. The other thing that may limit your ability to use these is something called constructive receipt, which says a cash basis taxpayer must recognize income when it is actually or constructively received, which generally means you can't turn your back on that income. And we'll talk about that in much greater depth in a future chapter.
What do you want to do today?
I don't know. What do you want to do today?
I don't know. What do you want to do today?
I don't know. What do you want to do today?
I don't know. What do you want to do today?
Our next tax planning variable or concept is called income shifting. And this involves adjusting the rate by shifting income between either entities, jurisdictions, or both. So Mr. Krabs is considering opening a new restaurant. So he's a new Krabby Patty is on the way. And he could either open it in Bikini Bottom or Shell City. The tax rate on income is 5% in Bikini Bottom. Tax rate on income is 9% in Shell City. So if all other considerations were equal, and they almost certainly never are, this is how that would work out, right? Obviously, the lower tax rate is going to drive smaller taxes, which is going to yield greater after-tax cash flow or value. So this is a simple shift, a simple tax saving strategy that employs shifting income between jurisdictions. Now, the reality is it's not quite as easy as we make it sound, though it does appear this way, right? So Amazon recently built a couple distribution centers. They certainly went out shopping for cheaper taxes. But you and I, individuals, we have a much harder time because it would mean we'd actually need to go and work in a different place. Even just living there often is not enough. You have to establish residency for individuals and all these other things. So in any event, it is a strategy that can be employed, though, in certain circumstances. Okay, Mr. Krabs is in the 37% bracket. Pearl is in the 12% bracket. And so what we're going to do here is an income shifting strategy that's extremely similar to the one that we covered earlier with Dr. Collins and her daughter in the kitty tax. Except this time, Mr. Krabs is going to hire his daughter Pearl as hostess of the Krusty Krab and is going to pay her $8,000. So note, this is earned income, right? This isn't unearned income, so it's not going to be swept up in the kitty tax. And if we ignore employment taxes, then Krusty Krab, Mr. Krab's going to get an $8,000 deduction and shift that income over to Pearl, who's going to have $8,000 in income. And obviously, it's an arbitrage tax rate opportunity. And this is fairly common practice, maybe not so much hiring your daughter to be a hostess, but the idea of shifting income down into individuals who have a lower tax rate, that is pretty common. You can see this just generates a simple tax savings because of that. So now he's considering incorporating the Krusty Krab instead, right? So again, he's trying to find ways to escape paying such high taxes. And he says, you know what, maybe I'll incorporate the Krusty Krab because corporations currently enjoy a 21% flat rate. My marginal tax rate is 37%. So we'd measure what taxable income is under both 100,000. The tax rate's 37 or 21. And you'd see that as a sole proprietor, he ends up with less after-tax cash flow than he does as a corporation. So as it stands right now, Mr. Krabs is thinking, hey, corporate structure looks like a pretty good way to go. But there are, of course, as we know, 2 layers of tax on corporations. So as a result, when that corporation distributes the earnings to Mr. Krabs. He'll pick those up. We're going to assume that he pays a 15% tax rate on qualified dividends. And as a result, he's got to pay tax on that distribution. But still, note that the corporation is still the winner. The net after-tax cash flows for the corporate form are 67, while they're only 63. So even including the double taxation on the corporation, right now it still is winning the race. However, we should know starting in 2018, there's this thing called the Qualified Business Income Deduction, and that's part 3 of the video series, but we can cover it at least briefly now again. And so basically what's going to happen is he gets to take a deduction of 20% of his flow-through income. So there are limitations and some other things. We'll talk about those shortly, but at least for now, let's assume he gets to take the whole thing. And so his taxable income is reduced only to $80,000. And now you can actually see that the sole proprietor is starting to win. This is the exact reason that the qualified business income deduction was introduced in the previous tax reform, is because without it, the corporate business entity started to become the favored business entity. And there are a lot of pass-through businesses that were really not happy about that. And so their lobby spoke up. And this is what we ended up with, some sort of measure to try to homogenize rate structures between corporate and pass-through entities. Okay, so one last iteration we're going to go through on this, and this is Mr. Krabs is going to use the profits to grow his business and doesn't need it to live off of, right? So one of the things we've looked at in all these previous versions is the idea that really the cash is being distributed to Mr. Krabs so that he can line his pockets and, you know, do whatever he wants with the money. Maybe take out Mrs. Puff. But if instead the idea is, look, I want to roll the profits back into the business, then we may end up with a different result, and sure we do. So in this case, the downside to a flow-through is you pay tax on the flow-through, whether it's distributed or not. So whether or not, as a sole proprietor, Mr. Krabs distributes that $70,400 out to himself, he still has to pay tax on it. In the corporate form, it's true it's double taxed, but it's only double taxed when that distribution is actually made. So as a result, as long as he's reinvesting all that money back into the business, it's actually more tax efficient for him to be a corporate form because it only has a 21% rate. And so even with the QBI deduction, that's a favorable form. Okay. So as you might expect, the complexities of the decision of what kind of entity you're going to choose, even though we can see that just the choice of entity alone creates shifting opportunities, they increase pretty easily by considering just a few non-tax factors. Tax is not generally the first item that most businesses consider when they think about where they want to be, what type of entity they want to be, et cetera, et cetera, et cetera. It is something that needs to be considered, but it's generally not first. Cost of labor, working rights, relationships with the other owners, all these things weigh in on exactly what kind of entity form you might choose. Okay, to continue our discussion of income shifting, we talked briefly about Mr. Krabs shifting income to his daughter Pearl, right? Because children generally have lower marginal tax rates, and therefore parents do work often to shift income to children, so it will be taxed at the child's tax rate. And we know the kiddie tax is one way of shutting that down to the extent it's unearned. We can also do that between owners and their businesses. So, for example, incorporating a business and shifting income from the individual to the corporation can result in lower taxation. We saw that. Shifting income from a corporation to an owner through a tax-deductible expense can allow the owner to avoid double taxation, right? So in our previous examples, we had the profits of the corporation being distributed to the owner through dividends. But it's also possible that they could be distributed through reasonable compensation, a reasonable interest on loans, or even if the individual owner continued to own the property that the business uses, it can rent it to that business. Thus, the rent is a deduction for the corporate form, but of course, it's income on the part of the individual owner. So the IRS is, super aware that taxpayers engage in this sort of behavior, and they tend to increase the level of scrutiny on related party transactions. There's something called an implicit tax that affects our ability to do income shifting. We certainly know now that the kiddie tax will. In fact, the shifting of unearned income over a certain dollar amount tends to work against most taxpayers. It can also create negative publicity. And there are some doctrines that are employed by the courts that aren't necessarily codified that limit our ability to shift income between taxpayers or between jurisdictions. So if Mr. Krabs wishes to shift income out of Krusty Krab Corp. And to himself, he can maintain ownership of the Krusty Krab land and building and rent those to the Krusty Krab Corp. And maybe he says, well, I want to get all the profits out of the corporation so there's no double taxation. So the rent I'm going to charge is 100% of the business profits. This would result in the Krusty Krab having no corporate income and no double taxation. But it also creates an untenable answer. So because it simply isn't appropriate to reflect a non-economic transactions with related party transactions. And so as a result, the IRS would likely reassert that the rent should be at its market value, not at 100% of the business profits of the business. And when Mr. Krabs pays Pearl to be the hostess, right? If the Krusty Krab is a self-seating restaurant, then of course the hostess isn't really a job. And so the IRS has the opportunity to revalue that compensation to its market value, which would be arguably zero. So Mr. Krabs uses profits to purchase investments that pay $10,000 in interest and dividends. So unless he puts those investments in Pearl's name, they remain his. So this is this idea of assignment of income, and you just cannot assign income to someone by saying, oh, the interest and dividends belong to them. You would need to put the asset in that person's name as well. And this dredges up this fruit and tree metaphor that I can't imagine the book doesn't cover, because every tax book on earth does. And we know about the kiddie tax, so I'm not gonna beat that up.
Is mayonnaise an instrument?
No, Patrick, mayonnaise is not an instrument. Horseradish is not an instrument either.
Of course, now let's shift to our third and final tax planning strategy, and that relates to something known as conversion. And I'm not sure why it's typically called conversion, because I like to think of it as character. So income can be generated in all different types of character. Ordinary income is taxed at ordinary rates. Those are the rates that we've been using thus far, the single, married filing, joint tax tables. Those are all taxes on ordinary rates. Long-term capital gains can be taxed at preferential rates. We talked briefly about long-term capital gains in the previous video, but not for very long. But they can be taxed at preferential rates, for example, 15 or 20% versus a much higher ordinary rate. And then, of course, some income is flat-out tax exempt, right? So there's a zero rate that applies to it. So you can see that the characterization of income can make a difference in the after-tax return that you might get from each of those different types of investments. And conversion is the idea of taking an income item or a deduction and recharacterizing it as a different form of income or deduction with either a lower or higher tax rate. So let's say you're an investment advisor and your clients pay you money to make good investment choices for them. So those are either commissions as a broker or fees as a fee-only advisor. And either way, that's almost certainly ordinary income to you. But what if instead you structure your relationship with these clients differently? And you say, you know what? I'm not going to charge you a fee in the same way. Instead, when you generate return, I'm going to take a piece of the return from you. So we're going to share in the return. Let's say for every dollar I make over the Dow Jones Industrial Average, you keep 80% of that money and I'll take 20% of that money. Now, to the extent that return is capital return, that is now capital gain as opposed to ordinary income. So I've taken the same sort of underlying transaction, but I've managed to recharacterize it to a more favorable tax character. So, this is something that is difficult to do. It's more likely that we're faced with a list of options from which to choose and maybe pick one that seems to suit us best. So here's an example of that. Sandy's contemplating 3 different investments, each with the same amount of risk, right? So just from the get-go, we can say we wouldn't expect a difference because, stocks always pay more than bonds, right? So we're just assuming risk is the same. So there's a high dividend stock that pays 8% dividends annually with no appreciation potential. So basically, they're paying out all their earnings through dividends and not really growing the business. Sandy could also invest in taxable corporate bonds. These corporate bonds pay 8% interest annually. And she could also invest in tax-exempt municipal bonds that pay 8% interest annually. So if we assume dividends are taxed at 15%, and that Sandy's marginal tax rate on ordinary income is 35%, which investment should Sandy choose? And it's a pretty straightforward calculation. So let's start with the stock on the left. $10,000 investment, 8% return would throw off $800 each year. The tax rate on that is dividend. So these are dividends being paid. So the qualified dividend rate is 15%. The tax would be $120, and so Sandy's after-tax return is the $800 pre-tax minus tax of $120 or $680. So the after-tax rate of return is only 6.8%, not the 8% that the pre-tax return was. With the bond's going to pay its 8% as interest. Well, interest is taxed at ordinary rates, which means that her tax is $280 or 35% of $800. So our after-tax return is only $520, which is only a rate of 5.2%. And lastly, of course, the tax-exempt bond pays 8% and has no tax. And so as a result, her after-tax rate of return equals her pre-tax rate of return of 8%. This makes the tax-exempt bond the optimal choice in this particular situation. So since after-tax is our end game, I think it's important we understand that relationship. And the way we're going to do that is look at it this way, right? So pre-tax minus tax is after tax. That's almost so obvious as to make it mundane. But if taxes equal pre-tax times the tax rate, which it does, then we can do a little substitution work on our first equation. And instead say that after tax equals pre-tax minus pre-tax times the tax rate. Now let's do a little algebra and pull pre-tax out of the right side of the equation. So then we're left with after tax equals pre-tax times 1 minus the tax rate. And this is a perfect shortcut that we can apply to the previous example. So let's do so. Stock was 8% with a 15% tax rate. That will yield an after-tax return of 6.8. The bond, 5.2. And of course, the tax-exempt bond, 8. So you can see that this little shortcut is a handy way to get to the after-tax return or cash flow or whatever it is you might be looking to examine. All right. So our friend Sandy, let's assume it's a different Sandy, works for the city of Bikini Bottom in the finance department. And her primary responsibility is for floating the city bonds out to the public. So think of her as being in the treasurer's office, and her job is to issue Bikini Bottom bonds out to potential bondholders. And one of the things that Sandy's noticed is that the corporate bonds that share all the same characteristics of Bikini Bottom's bonds are paying interest rates of 8%. Now, of course, the difference is corporate bonds are fully taxable. However, Bikini Bottom bonds as a municipal bond are tax exempt. And let's further assume that Bikini Bottom has only 2 investors, SpongeBob with a marginal tax rate of 35% and Patrick with a marginal tax rate of 12%. So think of SpongeBob being on the high income earner end and Patrick being on the low income earner end of the spectrum. Okay, so now Sandy considers the following hypothetical. So she says, if I'm SpongeBob and I'm comparing the taxable bond to the Bikini Bottom bond, well, the taxable bond pre-tax was 8%, after-tax was 5.2%. Whereas the Bikini Bottom bond, well, that's 8% pre-tax and after-tax, making that clearly optimal and by a long shot, right? 8 versus 5.2%. With Patrick, because his tax rate is lower, the after-tax on the taxable bond is 7.04%. But again, the Bikini Bottom bond is still superior because there's no tax on it at 8%. But you can see the difference has shrunk considerably between the delta between the advantage that the tax-exempt bond has over the taxable bond between SpongeBob and Patrick. So Sandy's degree is from SDSU. And she knows that the after-tax return on Bikini Bottom bonds is higher than comparable bonds. And so Bikini Bottom could save some money if it just lowered the rate on its bonds. So rather than paying 8%, maybe it could pay something less. So if Sandy lowers the bond rate to only 5.2, then what would happen is SpongeBob would become indifferent between the taxable bond and the tax-exempt bond. We call that the tax equivalent yield. So we have a tax-advantaged instrument like municipal bonds against a non-tax advantaged instrument, a corporate taxable bond. And we can get the tax equivalent yield by lowering the rate of return on the municipal bonds. At 7.04%, Patrick will be indifferent between the two bonds. So for example, if Sandy lowers the Bikini Bottom interest rates to 5.2% on the next issuance, then she's probably not going to get too many Patricks to join the system because they're better off buying the taxable bond, right? If Bikini Bottom is only paying 5.2%, then Patrick's better off in the 7.04% after-tax taxable bond. So what has to happen is Sandy has to gauge whether enough SpongeBobs that she could offer her bonds at 5.2%. So that's called a tax clientele. And so what Sandy's interested in is, can the tax clientele of high tax rate taxpayers support her bond issuance? And this is exactly how the municipal bond market works. So the difference in the pre-tax return of a tax advantage investment is known as the implicit tax. So when you look at SpongeBob's arrangement, his pre-tax return on the taxable bond is 8. His pre-tax return now on the Bikini Bottom bonds, thanks to Sandy, is 5.2. Whereas, of course, he is indifferent in the after-tax rate because they share the tax equivalent yield. So what's happened is an implicit tax has been applied to SpongeBob's Bikini Bottom investment. By lowering that pre-tax return, SpongeBob is paying a tax. It's just implicit in the return on the bond as opposed to an explicit tax that he pays by writing a check to the government. And again, this in fact accurately describes how the municipal bond market works. Bonds of similar risk and duration, if they are municipal bonds, they will pay a much lower rate of return as a result of the implicit tax applying to them. Okay. So there are, of course, limitations. We talked about some of the limitations with the timing. The code is full of provisions that prevent us from recharacterizing income as a different type, right? Because if it were available freely, then I would reclassify all of my income as tax exempt and therefore pay no income tax. But of course, you cannot do that. And now we know that implicit taxes are also going to reduce or even completely eliminate the advantages of conversion strategies. All right, that brings us to the end of part 2. I look forward to talking at you some more in part 3.
I know what I want to do today. It's called the Ugly Barnacle.
Can you take hats in a dignified and sophisticated manner?
You mean like a weenie? Okay. May I take your hat? May I take your hat?
All right, I've heard enough. You've got the job.
Patrick, I started something funnier than 24. 25.
Wait, SpongeBob! We're not cavemen! We have technology! Somewhere else!
Pinhead, your time is up. It didn't work.
You got it set to M for Minnie, when it should be set to W for Wumbo!
Patrick, I don't think Wumbo is a real word.
Come on! You know! I Wumbo, you Wumbo, he, she, me, Wumbo! Wumbo, Wumboing!
I wonder if a fall from this height will be enough to kill me.
Wumbology? The study of Wumbo? It's first grade, SpongeBob!
Patrick, I'm sorry I got... The classroom. And here's the chalkboard. It's the ladle that helps us drink from the fountain of knowledge. And those drinks are recorded here on the Good Noodle Board.
Get out of here, you stupid, dumb animal!
I love you.
And now, with two hands, have your net. Patrick, mix them up while I find the dispenser.
Firmly grasp it in your hand. It's a giraffe! Firmly grasp it. Firmly grasp it! Is mayonnaise an instrument?
No, Patrick, mayonnaise is not an instrument. Horseradish is not an instrument either. Can you take hats in a dignified and sophisticated manner?
You mean like a weenie? Okay. May I take your hat? May I take your hat? May I...
All right, I've heard enough. You've got the job.
No! My name's not Rick! Wait, SpongeBob! We're not cavemen! We have technology!
It didn't work.
Is this the Krusty Krab?
No, this is Patrick.
Is this the Krusty Krab?
No, this is Patrick.
Is this the Krusty Krab?
No! This is Patrick! Just like a genie!
Just get out of here, you stupid, dumb animal!
And now, with two hands...